If you want to make sure you get every tax deduction you're entitled to as a therapist working in private practice and not overpay your taxes, then today's video is for you. Hey team, I'm Dave. I'm a financial planner and founder of Turning Point Financial Life Planning, where I use the tools of financial planning to help therapists grow their impact and live the lives they feel called to live. Today, we are going to talk about taxes and making sure that you take all the deductions you're entitled to and don't overpay on your taxes. That probably sounds confusing and it sounds like a lot, but don't worry, we're going to break it all down and walk through it quickly. But first, you might be wondering, wait, remind me, what the heck are tax deductions and why should I care about them? Remember that you only pay income taxes on your taxable income. Taxable income is what's left over after you've deducted all the appropriate business expenses. That's why business expenses are sometimes known as deductions or write-offs. If this is sounding and looking unfamiliar or confusing, be sure and go back and listen to my video on understanding the basics of your practice's profit and loss statement, or P&L. There, I'll walk you through how specifically these expenses reduce your taxable income. Before we dive into the details, quick disclaimer, this video does not contain any tax advice for you to implement. These are just general concepts to keep in mind. Be sure and work closely with your professional tax preparer or follow the directions of the tax prep software you're using quite carefully. If you suspect you are in a little bit over your head and need some professional advice, be sure and seek that out. All right, so without further ado, let's jump into the top 7 tax tips I want every therapist to know before filing their taxes. Tip 1, consider shared personal expenses. These are expenses you incur in your personal life, but actually a part of what they do is support you in your business. So think through what activities you might include: mobile phone bills, home internet bills, financial planning fees, tax return prep fees, whether you use a professional or software. A portion of these fees can be allocated to the business. Probably shouldn't be 100%, but up to 80% or so is a good maximum rule of thumb number, and you can include those expenses in your business. This is something many people just don't think about, and therefore they're overpaying on their taxes because they haven't taken all the tax deductions that they're truly entitled to. Tip 2, education expenses. Sadly, these are not fully deductible. Once you're licensed, then really all education expenses, including continuing education, are completely 100% deductible. But up until the point of licensure, until you pass your exam, really none of those continuing education expenses are deductible. So your master's program, test prep fees, even the test exam fee itself, generally not deductible. I realize this is a bummer, but it is just the way the rules are. But there is more good news in the tips ahead. Tip number 3, big expenses may be subject to capitalization and depreciation. What are we even talking about? This is a really technical area, but just keep in mind that if you've made a big purchase, if any single item has cost over $2,500, that might be flagged for this capitalization and depreciation. This is a confusing tax concept, but all it really means is that the IRS wants you to spread the deduction over multiple tax years instead of just taking the deduction in the year you've purchased that item. If this becomes an issue for you, if it gets flagged, be sure and talk to your tax preparer and ask whether you are eligible for the Section 179 deduction or special bonus 100% depreciation. Confusing tax terms, but what it means is that you will, in fact, be able to deduct that full purchase price in the first year, which will save you tax money this year, and that's really what we want to do. Tip number 4, food and entertainment expenses. So sadly, entertainment, amusement, recreation expenses, completely not deductible. So you'll have to exclude those from calculation of your taxable income. Food, on the other hand, is deductible, but generally only 50% deductible. So only 50 cents of every dollar you spend on food will be deductible. That will change a little bit for tax years 2021 and 2022. In those 2 years only, meals purchased from restaurants will be 100% deductible. Everything else continues to only be 50% deductible. One final point about documentation for these food expenses. It's a bit stricter than general business expense documentation. You'll want to save those receipts, of course, always save receipts. And in addition, on that receipt, I suggest you write down who was at that business meal or who was eating that food, what is the business relationship of those individuals to you, and what was the business purpose of the event or the meal that you were having. Snap a quick photo of that receipt, save it in your tax directory, and you should be good to go from a documentation perspective. Tip 5, if you are being taxed as an S-Corp, please have in place an accountable plan. This isn't some big scary thing. It's just a policy and procedure which governs how you reimburse yourself for personal expenses. And yet it is very important. If you don't use an accountable plan and you have an S-Corp, you'll create a little bit of a mess. My full blog post contains some more detail and resources about how to put that plan in place. So be sure to click through. The link is below to the full post and make sure that you've got your expenses organized in this manner. Tip 6, beware the home office deduction. Now, I don't want to scare you. You should take this deduction if you're entitled to it. And I want you to be really well aware of the rules because the IRS loves to ding people here. There are 2 rules. You will need to satisfy the requirements in both of them to be eligible. Rule number 1 is that you must have a space in your home which you dedicate to regular and exclusive use for your business. The regular part, that's pretty easy to satisfy, just somewhere where you consistently do some work. But the exclusive part, that is trickier. You need to allocate, kind of cordon off a portion of your home where you do nothing but work. You cannot store personal belongings there. You can't host game night there. If you walk through it to access another part of your house, that's okay. But if you're doing anything else other than walking through it, you probably will not be able to satisfy this component. Now, you can cordon off even a very small portion of your house, even if you have a very small home like a studio. That's completely fine, but it needs to be exclusive use. The second rule is that it needs to be your principal place of business. Now that sounds confusing because you may well have an office outside of your home where you see clients. That's okay because you can create an administrative office at home. Now that administrative office needs to be the principal place where you conduct substantially all, to use the IRS term, substantially all of your administrative work should be conducted in your home office. So that's really anything you do in your business other than see clients. If you do that, you will have satisfied both requirements and you're eligible to take this deduction. How much is the home office deduction worth? Great question. There are 2 different ways you can calculate it. The simplified method, which is simply $5 per year per square foot of home office, or the regular method. The regular method is more complicated, has more documentation requirements, but if your home is more expensive or your home office is bigger, it will likely yield you a greater deduction. My full blog post, link below, outlines exactly how to calculate the deduction via the regular method and even includes a simple worksheet which will help you estimate how much the deduction could be worth. Now, if you are taxed as an S-Corp, there are special rules because, of course, there are. Again, check out the blog post where I walk you through how to claim the home office deduction in that case. Tip 7, beware the personal vehicle deduction. Again, I don't want to just scare you. I want you to take this deduction if you're entitled to it, but we need to be careful here. It would be great if we could just take our lease payment and fully deduct it, but we are not allowed to do that. There are some special rules here, and there's 2 different ways you can calculate the deduction to which you're entitled. One is the standard mileage rate, and the other is the actual expense method. I'll get into those details in a moment, but for either of them, you need to keep careful track of your business miles driven. So let's talk about first what those are. Business miles are those miles you drive for work purposes, visiting a client, going to see your accountant or your financial planner, running an errand to buy office supplies. These all count. However, commuting from home to your office, those are not business miles. But there's a catch. If you've established a home administrative office and you drive from that home office to your other primary place of business, that isn't commuting anymore. That is driving between 2 different business locations, and those are business miles. So another perk of establishing a home administrative office. All right, so you've totaled up your business miles driven. Now let's figure out how big the deduction will be. Again, 2 methods. There's the standard mileage rate, which is simplest. You simply take those miles and you multiply them by the IRS determined rate. For 2020, that rate is 57.5 cents per mile. For 2021, it's going to be 56 cents per mile. But if your car is very expensive, you might want to explore the actual expense method that may yield you a bigger deduction. Under that method, you'll need to keep track not just of business miles driven, but also the total miles driven by that vehicle during the year. So easiest way to do that, snap a picture of the odometer reading on January 1 and then again on December 31. I walk you through the details of the actual expense method on my full blog post, the link to which is below. If you want to really maximize the value of this deduction, each year you should calculate the deduction available to you under both methods and then pick the number that's higher. But there's a catch. If you own your vehicle, you have to use the standard mileage rate in the first year you own that vehicle. Otherwise, you can never use the standard mileage rate. If you lease your vehicle, sadly, you'll just have to pick one method and use that one method for the entire term of the lease. Why? I have no idea. These are just what the rules are that the IRS has come up with. All right, folks, that is a wrap on this week's video. While we covered a lot of ground, I hope you found it helpful. If you have any lingering questions or confusion, please reach out. I would be more than happy to answer any questions you have. I've also included links to some other videos I've prepared that might help you think through some matters as you begin to prepare your taxes for this year. Thanks for watching the video, and I hope you have a great rest of your day.